Thank you. Good morning, everyone. It's a real privilege to be here today to be moderating this panel, which is perhaps one of the most imaginative and provocative titles I've ever heard in relation to AEOI. So I'm very much looking forward to this. And I'd like to start by briefly introducing my fellow panelists, who together have a combined decades of experience in FATCA and CRS, and also benefit from coming from a real wide and diverse range of backgrounds, so it should lead to a very rich and engaging discussion. So on the outside we have Corinna, who is the EMEA Client Tax Information Lead for Standard Chartered Bank. And Corinna has set up the Client Tax Information function at Standard Chartered, including a global governance and reporting framework, and has lots of experience in delivering FATCA and CRS training around the world, including to banks and competent authorities in Africa and the Middle East. In the centre we have Paul, who is the head of the Harmful Tax Practices Unit at the OECD, as well as a senior advisor on exchange of information and international cooperation. While at the OECD, Paul has been responsible for developing international standards and policies to enhance tax transparency and beneficial ownership information, including through the Common Reporting Standard and the Crypto Asset Reporting Framework. And of course we have Kazimi, who I think everyone in the room probably knows, is the managing partner of Hansuke and actively advises banks on financial reporting and regulatory governance matters, including, of course, FATCA and CRS. And a very brief background for myself: I'm the head of tax at Starling Bank. I'm responsible for the UK and international tax affairs of the bank, including, of course, FATCA and CRS. So I'd like to pass to Paul first, if that's okay, to introduce the topic, and then we'll move on from there. Thank you.
Thank you very much, Hardeep, and good morning, everyone. First of all, thank you to Ali and his team for the invitation. It's certainly a pleasure to be here, and I, of course, have the challenge to address, as Hardeep has already said, the provocative title, Is AEOI Aging Disgracefully? Now, I have to say, bearing in mind that I've been in this space for almost 10 years, I hope it's not a reflection on me. It's certainly a bit of gray hair, but otherwise I hope it's still more or less okay, holding it together. No, but what I would like to do in the next couple of minutes is maybe take you a little bit through the journey of automatic exchange of information and share with you some reflections on where I think we have come from, where we are, and where we might be going. I think maybe going back to the beginning, the reason, of course, why we embarked on this exercise of introducing automatic exchange of information on financial accounts was to put an end to bank secrecy and the problems that posed to the global financial system. And I think it's sometimes useful to recall that that's the kind of sentiment that this policy ultimately came from. It's something that I think the younger ones here in the audience may have difficulties remembering, but I can still very vividly remember from my early days in tax advisory that there was a large group of countries that considered bank secrecy to be on the level of constitutional rights, and that was how the discussion was approached. And I think we have certainly seen a shift in that balance over the last 10 to 15 years. Now, one question that one can, of course, ask, and I think certainly for those of you that are active in the financial sector here in London or elsewhere, is all this work that we have been doing over the last 10 years, is it worth it? What has it changed? And I think that's certainly also a question that we have asked ourselves. I mean, there are the obvious numbers, which is that we have 110 jurisdictions participating in automatic exchange, of which all financial centers. There is, I think, now increasing economic evidence, both from academia and from researchers with governments and international organizations, that there is a significant impact. I mean, I think if you would need to point it down to four numbers, I think it would be probably the following. So there's a total of 126 billion of additional revenue that was raised thanks to automatic exchange of information, including, and I think very importantly, over 40 billion in developing countries, which I think shows that this is having an impact far beyond the traditional OECD membership that started this initiative. And I think also if you look to to the amount of exchanges that are now a reality. I think if you take the figures for 2022, which indicate that there are now 123 million accounts being exchanged, or information on 123 million accounts, with a total value of over 16 trillion on those accounts. I think we're talking serious numbers, and I think it is evidence that the world has really changed in this space. Now, I think this is, of course, the positive message, and I like to begin with the positive message, but I think it's also fair to say that financial markets have been changing and financial practices have been changing, and I think some of the provocative title probably comes out of how does this policy operate in a business as usual environment, and are the due diligence procedures, the way the reporting is structured, the way the reporting is done on an annual basis, is that still fit for purpose? And I think that's also a question that we are actively asking ourselves. Maybe first on the substance and then on the procedures. I think the reflection on the substance is that we have had I hear a bit of an echo, it's confronting. Is that we have heard over the last couple of years increasingly from the financial sector that we need to make sure that also new financial developments are reflected in the automatic exchange policies, and so that's, I think, a very important reason why we have designed the crypto asset reporting framework, because we of course don't want that the gains that we have made on more traditional bank accounts, insurance products, fund products, get eroded through the existence of a new significant financial market. And so that work has been concluded at OECD level now a little bit over a year ago, and implementation is well underway. There is a European directive, the DAC 8 directive, and there are now close to 60 countries that are committed to implementing the crypto asset reporting framework in the next couple of years. I think 2027 is the target date in respect of 2026 information. I think it's a demonstration that the idea still that automatic exchange can overcome issues of transparency in financial markets is still very much alive. Now, I think it's fair to say that it's not without challenges. I think probably the most important challenge that we see in the crypto asset market is how to deal with decentralized forms of finance. It's of course, I think conceptually very fair to say that the entire policies of the CRS and the CARF are designed on the idea that there is an intermediary that you can point to that can take care of these reporting obligations. And I think, of course, if you see how decentralized finance is working, that is not immediately a self-evident question. It is something that we are very much aware of. The CARF was designed to also have the capacity to cover decentralized finance, and there is commentary on that, and we are, I think, at the moment working intensively on how we can provide further guidance on how this can play out in a practical and realistic manner. Then I think it's now maybe also time, and I'm very conscious that I'm getting close to the limits of what should be my introductory 10 minutes. I think it's also time to speak maybe as a last point about some of the challenges that we are seeing to this architecture. I think firstly, and maybe importantly, now that this is business as usual, there is of course also now we are getting increasing sentiments that there are, and not only sentiments, I think you can see it in the press, that there are challenges being mounted against this policy. There are a couple of angles that are being used. One is in relation to the proportionality of the policy. So is it necessary to exchange this on an annual basis and do this on a global scale? I think we can certainly either in this panel or later on at the social moments have lengthy discussions about what the different perspectives on that may be. I think there is clearly also an angle of the right to privacy and data protection that certain of the more critical voices on these policies mount, and I think that's also something that we have to take very seriously, bearing in mind that of course this is a reflection of a fundamental right, and therefore of course something that needs to be brought and kept in sync with the policies that we operate. Maybe finally, I think one thing that we are also working very actively on, including with tax administrations, is to think how can we improve the burden of due diligence on these policies, and of course there is a big question. I think are there IT developments possible and sensible where actually it would be the tax administration that would confirm the identity and residence to the intermediary, which would then take away in turn the necessity to do the due diligence if there is already certainty that this identity is real and confirmed and that it reflects the tax residency situation of that taxpayer. It's what we call a government verification service with a bit of technocratic lingo, but I think that's also something that hopefully going towards the future can significantly improve the way this policy works. Maybe in closing, an upbeat remark, and also very much referring to Ali's very impressive introductory remarks this morning. I think for all the things that you can say about how technically perfect or imperfect, how well it is aging or not aging, this policy domain is, what keeps me personally always hopeful is that I think that tax transparency and maybe even international tax policy a bit more broadly is certainly a domain where multilateralism still works, where people are around the table from all corners of the world and from all different constellations that one could think about. And I personally have to say that I always find it a good sign that we can work together on these kind of subjects and be open, frank, and have a consensus-driven debate. So maybe there is more hope in the tax arena than one would typically think. Maybe we can show a positive example here far beyond just tax reporting. So with that, I think I hand back to Hardeep for the rest of the discussion. Thank you very much,
Paul, for a very insightful opening address. If I could turn to Corinna, please, to firstly respond to some of the points that Paul made, but as well as FATCA has been in place now for 10 years and CRS for 8 years. So looking back over that period, what are sort of the key challenges that you've come across in your experience, and how have you managed to overcome those?
Yeah, so looking really back 8 years or 10 years when FATCA came, one of the main things is Standard Chartered Bank is really national bank and has a footprint in more than 50 jurisdictions, so we're covering quite a lot of ground, and also, of course, jurisdictions where many financial institutions may not have a kind of a location, like developing countries. And so the challenges we were facing, or have been facing, are really, of course, everything started initially with a project. And of course, the project, when FATCA came, there were so many things of, oh, well, how can this work? And we take a very broad approach and very US-centric. But when CRS then came into our lives, really realizing CRS is really absolutely, FATCA is getting drafted, it's really not going to be as important anymore in terms of automatic exchange. Really, CRS is going to run this. The project itself was set up in a much broader way, but the decisions we initially made in the project phase and the people who were engaged in the initial project have maybe long left the bank, not the same people working on this anymore. And the decisions which were initially made were made on presumptions, which we now, with the experience now, sometimes didn't held up for. So like something like, the response rate of customers, for example, to request a self-certification. Very simple things. It was always anticipated, the standard says, okay, we have to request self-certification. It's a very simple sentence, it's very simple request as such, but the equation has to be made with the customer himself, herself, and there really lies the problem. And in particular, because we do not have under CRS a minimum threshold, as we have for FATCA, for example, requesting self-certification for every client where you may see a foreign indicia, makes it really challenging. And the lower often the balance on the account, the smaller is the response rate, something which means you still have to report on people having a minimum balance, and not every jurisdiction has implemented this kind of whatever rule where jurisdiction can make a choice on to say, okay, do we have this minimum of low value accounts of 1,000? So we have to report even like £10 or something like this, and which means has really no relevance when it comes to tax transparency, because what is the point here? But we still have to apply this, because it's simply the rule. And because of all these things, so how the project really worked, what the project anticipated, saying, okay, we request a self-certification from everyone, we do not make a carve-out, we do not, it's easier to request a self-cert than rather using for entities publicly available information. Everything completely has shifted over the 8 years, and we have now really, in particular, when it comes to investment business, our segments there, and big corporate business, we've really made the decision to hugely rely on our internal procedures, to use the full scale of the standard to say, okay, this is permissible, this is allowable, okay, therefore we have developed very complex processes, which really we developed once the project was closed, more or less. So it was the project in the kind of BAU environment then, so that's what we really had to take on, and which is really continuing up till now, to develop something which is really then fit for purpose, fit for day-to-day business. And so these things are still challenging us, and also then, of course, all the different developments, updates from each jurisdictions, saying, okay, when it comes to tax IDs, invention of tax IDs in certain jurisdictions where there was no concept, or there kind of tax IDs, because like Middle East jurisdictions mainly have no concept of income tax. So what do you use then as a proxy? The invention of some sort of proxies for tax IDs, but also then updates on certain jurisdictions to interpret what is a tax ID, and then providing very particular advice or instructions that a tax ID has to reflect for CRS purposes this or that number. For example, we see in Switzerland something like this. They request the country company registration ID as the tax ID, despite the fact that, of course, Switzerland has got tax IDs. So there are so many things which need to be updated on a very regular basis, and there are so many complex processes around to monitor this, and so therefore we never anticipated when the project started it would really run that way, how complex it has become, and also how many decisions we made initially had to kind of throw over and say, well, not so good anymore, it's not fit for purpose, we have to take it from another point. So, and really start from scratch.
Thank you very much. I think you've articulated very well some of the complexities of having a consistent set of rules that are rolled out internationally, and some of the problems that brings. And Ali, if I can ask you the same question, actually, both from a UK and international perspective, what are some of the key challenges you've seen looking back over your experience of dealing with FATCA and CRS?
Sure. So just going back to the title, I don't know whether the regimes are maturing disgracefully, aging disgracefully, but certainly the compliance programs, the FIs, they are certainly aging quite disgracefully. I think for the reasons that Corinna sort of like pointed out, the longevity is not there. What we have currently inherited, many people have inherited from other people, you know, who've long gone, is a program that's not producing accurate information. And that's a problem. Okay, so I don't think we can sidestep that. Obviously, my view is generally slated because as an advisor, I get called in when things go wrong. But certainly, you know, most people won't call you if there's nothing wrong. But anyway, the point is still the same. Now, the root causes for why things have gone wrong, I'm reminded of that, I don't remember the exact quote, but, you know, Tolstoy in War and Peace, he talks about all happy families being the same and all unhappy families being unhappy in their unique ways. And similarly, when things go wrong, each organization has its own challenges. And certainly we have seen some rather interesting cases, should I say. There was one financial institution who reported all the information correctly the first year, and every subsequent year they only reported the new accounts that they added in the year. So basically, you've got, whatever, 10 years of incorrect filing, okay, and you go and deliver this, and the CFO's upset, and so on. So there's all the internal dynamics that go with it. So I think that quite often is a challenge because, you know, as an outsider, you know what the right answer is. You know what needs to be done. But you have to understand the nuances and the politics of the organization, which sometimes prevents us from getting to the answer very quickly.
Thank you very much. And just thinking about the landscape of FATCA and CRS today, what are the key difficulties that you're experiencing in today's world, be it, you know, interpretation of the rules or actually trying to implement the same processes and procedures across the globe? If I could turn to you first, please, Corinna.
Well, yes, there are still challenges coming across our business. So one of the main businesses really that the common reporting standard becomes even more uncommon. So even initially in 2016, we knew, okay, it was named common reporting standard, but it's not as much as very common, even when it started, when it came into effect. But I think this is deviating, jurisdictions are deviating from the rules even further and even more. And this is, I think, or well, what we observe, mainly driven because, of course, jurisdictions have authority and jurisdictions who really enforce it because there's some, in a way, where there is some kind of room for interpretation, but also some leeway, how jurisdictions can enforce it. So it's simple things like, okay, you need to have strong measures in place. What does this constitute, like having strong measures in place? So then the law, it gets changed, and we see, for example, in certain jurisdictions, which means you have got to the additional annual reporting, you have got an ad hoc reporting, for example, as a kind of, if the customer doesn't provide the relevant information on the self-sort, if the self-certification is invalid or not complete, like in Germany, for example, yeah, so you have to always then have a look on it, and also there's a component of that you have to judge as a financial institution, okay, does this constitute really this kind of offense where you then have to take the steps of this additional ad hoc reporting to the authorities? Yeah, and of course, something like in the UAE, we see that there's a very harsh penalty regime where financial institutions become the enforcement agency of the penalty, which then causes a lot of additional logistical problems to have a process in place. Really, how do you enforce this? How do you charge this penalty to the client, which you then have to transfer then to the authorities? And what is here in this context, a strong measure? And of course, so this really filters and trickles down to us as a financial institution, and really quite extreme. You would never think as a financial institution in this context that you suddenly become an enforcement agency. And I think this is from our point of view, a step too far. And because of this kind of interpretation, what is what, and the compliance regime has been developing around CRS quite a lot over the years, and with the peer reviews coming, yeah, and then findings from the peer reviews, so jurisdictions have to amend their local legislation. We see then this comes back to, okay, everyone has done very individual take on the findings, how they really translate this into new legislation, which also then means that we have to operationalize it even in very small jurisdictions where you think of, is this really where the critical mass is, or the impact is, where have to introduce it and operationalize it into local legislation, into local processes, and really very much based on their interpretation. And I think there's not much financial institution can do just to really influence authorities in their findings, in their way of how they are operationalizing it, or bringing in new laws. So there is no active conversation, communication, how this can be achieved. It's just like, okay, that's what you have to do, and there's no way of collaboration, is this really reasonable in this context? Yeah. And I think this is one of the biggest challenges we are really, really facing.
Yeah, and there's a very interesting contradiction that you highlighted there between financial institutions becoming enforcement agents on behalf of the tax authorities and yet being fined for non-compliance. So on the one hand, they're supporting and helping the tax authorities to gather information to potentially run inquiries and close the tax gaps around the world. However, they're also being fined for non-compliance, and those fines are then being passed through to customers. So in your experience, have you seen any situations where maybe customers are no longer doing business with an FI due to their FATCA and CRS reporting regimes, or even where businesses are choosing not to go into a jurisdiction or to remove themselves from a jurisdiction due to the harsh rules? Yeah.
That's very much true, yes. So it's a really a huge challenge. So, and it's ongoing, and we don't see anything from the OECD intervening maybe there, and what is reasonable? Is there anything, what can financial institutions do just to get heard on this point?
This won't be the first time, Paul, that you'll be asked
No,
to
no,
represent
no,
the
no, no.
OECD. So if you can please give your views to that.
So, I mean, I think it's of course not a coincidence that the product was labeled and is labeled Common Reporting Standard, because I think it also reflects something which I think is a theme in tax transparency, which is there is firstly a global action problem. It only makes sense to introduce these reporting regimes if everybody participates. Otherwise, you may as well not do it, because then it's of course clear what would happen. And secondly, I think there is also a real interest and need that this is done consistently around the world, so that you don't end up with 110 different sets of rules. And so, I think the idea of a common standard reflects that, but I mean I fully agree with Corinna's remarks in terms of that there is a tendency, of course, when this gets transposed into domestic legislation and domestic guidance gets issued, that this becomes an uncommon common reporting standard. Maybe two avenues and one remark. I think one avenue you have highlighted, which is the peer review process that the Global Forum is running, which of course looks into the legislation and the practice and tries to make sure that it is in line with the standard. And secondly, we are always and still available to issue further guidance out of the OECD on interpretation issues. Of course, one big source of inspiration is what comes out of the peer reviews and what comes from the jurisdictions that have implemented the Common Reporting Standard. But I would say an almost equally important and something which we actually very much encourage is from you, from the business community that is dealing with this on a day-to-day basis. And so if you see issues where you think this is really becoming a major operational issue because there is an interpretation that we think is problematic, or there is an interpretation that we would very much welcome because it would make our life easier, reach out to us either through business at OECD or directly to the Secretariat, and we can take that up and put the question and the desired answer to delegates, and usually there is a willingness to find a pragmatic solution. There's maybe one caveat that I should make, and I think it's maybe also helpful to contextualize, for instance, the issue in the or the approach that you have highlighted in the United Arab Emirates. Section 9 of the Common Reporting Standard on enforcement, effective implementation, sanctions, we deliberately left very general and outcome-driven. So the only thing that you will find in there is actually not rules, but they're more like hallmarks in terms of outcomes. And that is largely due to the fact that there are very different legal systems, including administrative and potentially criminal enforcement that we need to respect in countries. But I think also very importantly, and those of you that work for global institutions will probably be very much accustomed to that, there are hugely differing compliance cultures. So I think if you would speak to a Scandinavian government, the way they would approach compliance by financial institutions is completely different from what you would see in other parts of the world. And so we would not want to intervene in that, and sometimes that may lead indeed to some results that you don't like in terms of risk and operational management, but I think there it would be more difficult for us to intervene because it goes well beyond tax reporting.
That's a fair comment, thank you. And Ali, from your perspective as an expert advisor, what do you think it is that your clients struggle the most with in terms of FATCA and CRS compliance?
Sure. So the current challenges are, as Corinna alluded to, I mean, you've got regimes like the United Arab Emirates who are levying fines and so on. So I think the moment when audits start, that immediately focuses attention on data lineage. How did you get to this numbers? And that's where a lot of the challenges, where the tax authorities are saying is, I know this is what you reported, tell me how, and importantly, tell me what you didn't report and why did you not report. And that kind of audit trail is absent, and that's a problem. And on the whole, I mean, what I find, particularly in the banking industries, they kind of have a decent attempt at it. It's not always right, but where the gaps are really around is the governance documents, and they're just not up to date or completely absent. And we're talking about large institutions, so I dread to think what's happening at the bottom end of the scale. So that's a real issue for the banking industry. But I'm less worried about the banking industry. The one that really concerns me is around the investment management, the wealth management industry, because to your point, we were talking about the importance of the role that the financial institutions play. And when you've got the responsibility, the legal responsibility, but then you've gone ahead and outsourced that to another third party, what does that look like? And what is the nature? What have you outsourced? You can't outsource the legal responsibility. So actually, all you've done is outsource the operational responsibility. So, you know what? If you're the investment manager and you're looking after funds, you better be sure what your transfer agent is doing, or whoever it is giving you proper numbers, because he's just keeping that side. Your custodian's giving you the other numbers as to what's the sort of like the reportable amounts. And, you know, and particularly take Cayman, for example, because Cayman's actually introduced criminal liability to do with these regimes. Well, if you've got Cayman funds, I would be very, very careful and start looking at and say, what is going on in my name? Because when the tax authority comes knocking, they're not going to sort of like say, oh yeah, Mr. TA, you did this wrong. They're going to come back and, you know, put you in the frame. And, you know, you're a regulated business, so getting these type of things wrong. I mean, I was Chris Orchard, who devised these schemes, is a colleague of ours. He couldn't be here. He's on a cruise at the moment, as he always is. I mean, he said to me, I mean, sort of like half seriously, half jokingly, he said, look, when we devised these things, we didn't sort of like say, hey, chaps, have a go. No, it doesn't work like that. You are supposed to, when you lodge a filing, it has to be complete and accurate. As a tax person or as a finance director, you're a regulated person. You're supposed to be exercising due professional care. Okay, so I think people need to just wake up and say, these regimes are there, get it right. The other area of non-compliance we see consistently is, I mean, I heard this the other day, it was just ridiculous. So they got some package which from PwC to check the W8s or whatever. So I said, you know, have you looked at all of this regime? They said, oh, no, PwC take care of everything. I said, I don't think they do, because if you ask them, you know, they're not going to sort of like confirm that your reporting is right. All they're doing is basically doing a W8 form, whatever check. And I think the over-reliance on advisors and understanding what the scope is really important. Okay. The third thing I was going to just basically finally add is, when these regimes first came out, they were brought in silos. So you had FATCA, then you had... The world today has MDR, it has DAC 6, which has a relationship to CRS. If you are a QI, qualified intermediary, your QI status can be completely affected by your FATCA compliance. Okay, and you're as a RO under a QI, you're supposed to tell them what your level of compliance is. So I think there's some real consistency checks that we need to do, CCO regime as well. Anyway, I'm being told to shut up. So I will shut up.
That's okay. Well, just from a personal...
Or otherwise, it's some sort of like sign language.
Well, just from my perspective, I work for, obviously, in the digital banking and fintech sector, and I certainly find that most of those organizations have grown very, very quickly. But also they've grown in such a way that they take on quite a limited set of clients. So they're limited in the type of entities that they take on and the type of customers. Yet the FATCA and CRS rules don't cater for that. They cater for, you have to introduce the whole set of rules to your organization, even if a lot of those rules are not relevant to you. So I think there's a real lack of proportionality for different types of organizations. As well as to Corinna's point earlier on, actually, a de minimis threshold would probably be extremely helpful in CRS, but unfortunately that doesn't exist. This is a great chance for me to put some pressure on Paul and say whether that's ever something that's being considered.
I mean, I think, so is there a threshold considered? I think the answer to that is probably no. There are, of course, and I think one should not forget them because they actually still play a role, some thresholds in the space of pre-existing accounts in particular. But I think if we look to the broader landscape of CRS reporting, thresholds are an incredibly thorny subject, and I think for a host of reasons. First, governments don't particularly like them because there are fears of that you split your wealth into 10 or 20 or 25 accounts and then everything would go unreported. Developing countries don't like them because they say, yeah, it's very nice for you as a UK or a German person to say that 10,000 euros or pounds is not a lot, but for us it's actually a meaningful amount of tax being declared, so we don't like these thresholds. So all this to say that we had this reflection in the context of the revision to the Common Reporting Standard, and I think there was little appetite to introduce that, with one exception. For those of you that have looked through the amendments of the Common Reporting Standard, there is a threshold for e-money. And that's precisely for these kind of considerations, that we don't want very small amounts to be reported and be subject, or very small electronic money accounts to be subject to due diligence obligations that can be quite burdensome. And of course, this question also comes to the surface in the crypto world again, and then there it's even more complicated. One dimension where I can see, based on the way those rules have been drafted, which include the notion that a crypto asset is only subject to reporting if it can be used for payment or investment purposes. That we may find ourselves in a situation in the maybe not so distant future to ask ourselves the question, is there some bright line test that we need to introduce in the space of non-fungible tokens? Because those of you that are active in this domain know that there is a lot of stuff. I don't want to start referring to Bored Apes or other things, but that may not necessarily have a financial component to it as a prime driver. So to be seen if we can land something there. I think there's certainly an appreciation, but it's a good old threshold question. It's very difficult in an international setting.
Thank you. Good answer, by the way. So just thinking about leveraging the experience across the panel, are there any particular areas of best practice or recommendations to optimize compliance that you can offer to some of the FIs across the room? Starting with you, please, Corinna.
Well, so first of all, I think it's really hugely important that you have a proper compliance program in place. I think that from the initial thought of, yes, it's a project and you operationalize it, okay, that's the first step. But really having a monitoring program, and not only monitoring, I mean then with changing circumstances, of course we all do that, but it's really monitoring really consistently, change in legislation, something like this, change in whatever publication TIN numbers, change in your entity, for example, setup. Yeah, most of us work in organization where it's a group somewhere that you've got really a compliance program as well for your group entities, so that you monitor those, all the latest development, that you have a kind of a program in place for all your new products. Also, yes, including, for example, whether it's relevant for new CARF rules, that you really plan ahead and know exactly they will be, they're out of scope currently for CRS and FATCA purposes, but they will come into scope, that you set it up. And it's really, and generally, having a compliance program, really looking at your have sample testing, see what you test really, how it's captured in your system. Because what we on a very regular basis see is, even if, well, we are the technical experts, even if you have understood and understand the complexity of everything, also with like new rules coming in or regulations coming in, like CBI area, RBI schemes around where you have to implement new due diligence. checks on the ground. All these things need to be implemented, operationalized again, and that your checks, that you check what is really actually in the system. How does the first line, these are our ops team, the first line, 3 lines of defense, on that basis, how do they look at these things? Yeah, do they really capture or spot what is really where it is to put the eye on? Yeah, it's not necessarily that there is a status, that there is a document, but how accurate is the data? How complete is the data? Is this really reasonable? What type of knowledge should they have? And this continues really monitoring of these things, yeah, that you get it really right. And I think this is so key, really to have this proper compliance program and that you expand your own compliance program on a really very regular basis. Yeah, that it's really that you have also need to have a risk assessment internally. What risks do you take on? Okay, you will never have complete data. Everyone has to accept this. Yeah, no one will have 100% self-certification, or every client account is fully valid and documented. This will not happen. You always will find, if you do end-to-end reviews for reporting purposes, that you suddenly find certain small things where you identify an error. Yeah, it could be something like, oh, we pull the data at a point where we cannot still find it in the system, so that there is a delay in terms of, because that's how our systems, existing systems work. Something is credited to a certain, to an account, for example, but you can only see it a few days later. And then depending on when you pull the data, okay, sometimes then suddenly it's in or it's not, or it's out. So something like this, you then suddenly identify. So you have to also then, which means, have a compliance program for your reporting process in place. How do you challenge yourself, and what do you find there? What additional risk controls do you have in place? And this comes only, it's really a strong learning curve, and that you anticipate this learning, and then you do not stop learning and saying, okay, we are going to make it better, and this is the lessons we've learned from this, and grow and grow continuously. I think it's not that you set it up once and that's it for all. It's continuously changing, and I think that's also probably the expectation maybe the OECD has.
Thank you very much. Great advice. And Ali, similarly, any pearls of wisdom from your time as an advisor to help inform clients and how to get this right?
Yeah, I mean, I echo what Corinna said about the compliance program, but how do you go about doing that? Because it's good to say, yeah, let's have a compliance program. But, you know, the problem we have in many financial institutions is, you know, when you look in the mirror, you don't find any faults. Okay? So, and in auditing, we have the concept of you can't mark your own homework. You know, it doesn't work that way. So I think, I'm not just saying this because I'm an advisor, but I think the need for independent reviews is really important. And I'll tell you why, because I'm not, just, as I said to you, not saying that because I'm an advisor now, but I was an advisor. I used to, as you probably know, head up the BlackRock tax team. And for the amount and the quantum that we were dealing with, it actually became an issue of risk management. And you said, yeah, my team is quite capable, and actually I probably know more about my funds than my external advisor. But I was really keen on defraying the risk out to an external advisor. And as you probably know, most of you who deal with the UK HMRC, well, you're ex-HMRC guy, but you know, the issue of you know, the automatic 30% penalty disappears the moment you say, I've got someone else to actually underwrite my risk. And some of these type of external reviews can be very short. I mean, it could be 3-4 days intense thing, get a report out, you get something, and then you can basically park it. But what you find through the external fresh pair of eyes are the gaps in the compliance program. Okay, when was the last, you know, policies and procedures looked at? You'll be surprised. I mean, the most P&Ps I open, the first thing I look for is, could you show me the classification of the FI and the classification of the other group companies that are not FIs, and could you give me a classification of the product set? Not there. Most P&Ps that I see are essentially regurgitating the HMRC guidance. And say, thank you very much. They have not been embedded. So I think, yes, compliance programs, but they have to be looked at for what they're supposed to be delivering. And there's a number of my clients in the room, and they will bear testimony to exactly what I'm saying.
And just on that point, HMRC have long threatened that they may carry out audits of FATCA and CRS. Do you think that may actually be beneficial, both for FIs to check their own compliance, but also for them to release budgets internally to sort of put in place really robust compliance programs?
Look, absolutely. I mean, whatever it takes to bring people into compliance. I mean, I think there are other regimes, particularly around the senior accounting officer regime. There are, which is not directly due with them, but nonetheless, I mean, the whole CFO or whoever it is, it focuses their attention on that. Within the banking industry, I mean, you have the code of practice, and I think these things, what it's a bit like, you know, when you walk into a firm, you can actually smell whether these guys are compliant or not. You probably know it from your HMRC days. You know, you can smell what's the level of compliance. But generally what I find is the moment, and I say to my clients, give me 30 minutes with your board, and they will be eating out of your hand because you put the fear of God in them. And you say, mate, you're responsible for this, okay? And many board members, I mean, they say, yes, CSR, we do a lot of that. And you're thinking, no, I'm talking about CRS. And as you probably know, I mean, Chris devised that audit program.
Yes.
And he said the first question we ask when we walk into an audit situation is, who's responsible for this at the board level? And they just look around and they're looking sheepish. Board members don't have a clue what this regime is about. So I think there's some real issues. So anything that can get it up there, absolutely.
Thank you, fantastic. We've only got 2 minutes left, so very quickly. Corinna, if you could change one thing about FATCA and CRS going forward that would improve compliance and ease the compliance burden, what would that be?
What will there be? That's a very tricky question. I think I would eliminate the complexity around this, and I think I would really have a proper template where we can run along, because I think this was really, in particular for CRS, was missing. At the beginning, when CRS came into our world, came into effect, the regulations were very vague, and they said, okay, that we are going to develop these. And of course, we had this compliance handbook, but it came, from my point of view, it came too late, and that left jurisdictions with too much kind of room for interpretation, and I think this should be more really standardized. I think really a proper standard as such.
Great idea. And Ali, same question. What was the one thing you changed?
Yeah, it was good. You asked me before.
Before I got to Paul.
Because I think, you know, fundamentally this issue of where you've got low risk institutions, so you've got businesses which essentially only deal in the UK, yet they must have the same governance framework, compliance program as someone like what Corinna's got, which is a global international bank. And I just think that's disproportionate. And if we can make use of the low risk, you know, sort of like easement, that was certainly there in the guidance, but it's just not been walked through. So I would like, you know, the authorities to give us the free pass to walk through that portal.
And for the final time this morning, Paul, do you have any responses to those two recommendations?
I mean, just to say that I think we see this very much as a living product, and we think it should be. So I think there is certainly always opportunity to make a case why certain, for instance, purely domestic. We know that it exists for FATCA, and we could now say much more about why it doesn't currently for the CRS, but I'll leave that for the coffee break. But certainly, I mean, it's very happy to take that up. I think if I would personally, for tax reporting, have the opportunity to make one thing change, then I would think that we should benefit much more from the possibilities, and it's a bit the theme of this conference, that technology offers. I think there would really be tremendous merit in a decentralized but still queryable tool for TIN numbers and tax residencies, and that unfortunately doesn't get off the ground. So if anybody wants to do a startup, give it a go. I'm sure that there would be interest, even if only 50 jurisdictions participate. So I think that would be a very interesting thing. And I think also we need to think much more about how technology and policy can relate to each other. And maybe as my last remark for this panel, one funny anecdote of recent times for the domestic implementation of crypto reporting in the US. Our US colleagues launched a public consultation in the last couple of months, and one outcome that they didn't expect was that those that don't like crypto tax reporting used AI to basically bulldoze them with comments, and they received 140,000 submissions, of which apparently the vast majority was generated by AI. So just to say that also for governmental consultations, there's a whole new world ahead of us.
Fantastic. Thank you very much to my fellow panelists for a very rich and engaging discussion.